Welcome back to Caveman Capital. Today we are looking at the single biggest threat to your generational wealth. It is not a stock market crash. It is not inflation. It is a slow, quiet crisis that happens inside the home. We are talking about long-term care. Most people ignore this topic because it is unpleasant. We do not like to imagine ourselves frail or unable to walk. But ignoring the weather does not stop the storm. Statistically, someone turning 65 today has a nearly 70% chance of needing some type of long-term care services. Let's define the beast. Long-term care is not medical care. It is not about doctors curing a disease. It is custodial care. It is help with the activities of daily living, eating, bathing, dressing, and moving. It is the help you need when the body simply wears out. Here is the great lie that destroys portfolios. Medicare will cover it. Let me be very clear. Medicare does not pay for long-term custodial care. Medicare pays for recovery. It pays for short-term rehab after a surgery or a fall. Once the doctor says you are stable, but you still cannot dress yourself, Medicare stops paying. The checkbook closes. From that moment on, every dollar comes out of your pocket, and the price of that care is rising faster than almost anything else in the economy. In 2026, the average cost of a private room in a nursing home is over $10,000 a month. That is $120,000 a year of after-tax money. Home health aides are charging $30 to $40 an hour. This is a burn rate that can incinerate $1 million savings account in just a few years. So how do we defend the cave? For decades, the only option was traditional long-term care insurance. You know these policies. You pay a premium every month, just like car insurance. If you get sick, it pays. If you die healthy, the money is gone. People hated these policies. They felt like throwing money into a black hole. Even worse, insurance companies mispriced the risk. Years later, they shocked policyholders with massive premium hikes, doubling or tripling the cost when seniors were too old to switch. Because of this history, many of you decided to self-insure. You think, I have saved enough. I will just pay for it myself. This is a valid strategy for the very rich, but for the middle class, it is a dangerous gamble with tax implications. If you self-insure, you must pull money from your investments. If the market is down when you get sick, you are selling stocks at a loss. Furthermore, money pulled from a traditional IRA is taxed as income. To pay a $10,000 bill, you might need to withdraw $14,000 to cover the taxes. Fortunately, the market evolved. Today, we have a smarter tool called asset-based or hybrid long-term care. This appeals to the caveman logic because it eliminates the use-it-or-lose-it fear. It combines life insurance with long-term care benefits. Here is how a hybrid policy works. You move a chunk of money, let's say $100,000, from your savings into this policy. In exchange, the insurance company gives you a leveraged pool of money for care, perhaps $300,000 or more. The beauty of the hybrid structure is that there are only 3 possible outcomes, and in all of them, your money is not wasted. Outcome number 1. You require long-term care. The policy pays out the benefits tax-free, protecting your other assets. Outcome number 2. You live a long, healthy life and die in your sleep. You never use the care. In this case, the policy acts like life insurance. Your heirs receive a death benefit. The money you put in, and often more, goes back to your family. Outcome number 3. You change your mind. A few years down the road, you decide you need that cash back. Most hybrid policies have a return of premium clause. You can walk away and take your original deposit back. You are not locking the money away forever. This creates a live, die, or quit scenario where you win, or at least break even in every direction. It turns the expense of insurance into an asset on your balance sheet. It is a parking spot for your cash that creates a massive shield. Another critical feature to look for is inflation protection. A benefit of $5,000 a month sounds good today, but in 20 years, it might be peanuts. You can buy riders that grow your benefit pool by 3% or 5% compound interest every year. Let's talk about the partnership program. Many states offer a long-term care partnership. This is a collaboration between the state and private insurers. If you buy a qualified policy, it gives you a superpower called asset disregard. Here is how it works. If your policy pays out $300,000 in benefits and then runs out, and you eventually need to apply for Medicaid, the state will allow you to keep $300,000 of your own assets above the normal poverty limit. It exempts your savings from the government. Speaking of Medicaid, this is the Plan Z for those who have no insurance and no money. Medicaid is the government program that pays for nursing homes, but only after you are destitute. To qualify, you must spend almost all your money. Medicaid is not a strategy, it is a tragedy. You lose control. You cannot choose your facility. You go where there is an open bed. And after you die, the state creates a lien on your house to pay themselves back. This is called estate recovery. So, when should you buy protection? The sweet spot is between ages 50 and 65. Before 50, you are paying for too many years. After 65, the premiums get expensive, and more importantly, your health might decline. Remember, your health is your currency. You can write a check for the premium, but you pay for the policy with your health. One diagnosis of Parkinson's, one stroke, or even severe arthritis, and you may become uninsurable forever. The door closes quickly. A special note for the women watching. Statistically, women live longer than men. Women are often the caregivers for their husbands. But when the husband dies, who takes care of the wife? Women need this coverage even more than men do. Couples should look for shared care riders. This links the husband's and wife's policies together. If the husband uses all his benefits, he can dip into the wife's pool, and vice versa. It creates a larger, flexible safety net for the surviving spouse. Let's address the cost objection. Caveman, this is too expensive. Look at the leverage. If you pay $5,000 a year to protect $500,000 of assets, that is a 1% cost to insure 100% of the portfolio. That is not an expense, that is risk management. If you do not have insurance, your entire portfolio is your insurance policy. You are self-insuring with every dollar you worked for. The question is not, can I afford the premium? The question is, can my family afford the catastrophic loss? Do not let the legacy of your hard work be erased by the final 3 years of your life. We build the cave to last. We store the food for the winter. Long-term care insurance is simply the gatekeeper that stops the wolves from entering the cave. Take a look at your plan. Talk to a specialist who understands hybrid policies, not just the old-school kind. Run the math. Tax-free leverage is a powerful tool in a tax-heavy world. Protect your dignity and protect your kids from having to be your nurses. Disclaimer. Before you go, a necessary legal warning. I am a content creator, not a certified financial planner, tax professional, or licensed insurance agent. This video is for educational and entertainment purposes only. The rules of finance are complex. Your personal situation is unique. Always consult with a qualified professional before making any decisions. Do your own research. Do not rely on a caveman for your legal defense.